Welcome everyone to this presentation on NFO of DSP Nifty Private Bank ETF and DSP Nifty PSU Bank ETF, which is starting from 17th of July and ending on 21st of July. My name is Devang Chavda. I work as Senior Manager in Product Team in DSP Mutual Fund. So let's go ahead with this unique offerings uh, by DSP. So let's look at how banking as a sector has evolved over the years and what has been share of private bank, PSU bank, and foreign bank, and even share of SBI. So when we see period of 2005 to 2012, around 50% of the banking business was being driven by PSU banks, around 25% by SBI, and the rest was attributable to private banks and foreign banks. So it means that around 75% of the banking business was being driven by PSU banks in India. But when we see the last decade from 2012 onwards, the share of PSU banks have been falling. So from 54%, the share has fallen to 35%, and that is compensated by that is being taken over by the private banks. So if we see share of private banks, it was around 18% in 2010, which is now around 38%. So share of private banks have almost doubled from this level. So now there are many reasons to why there has been a growth in the share of private banks. So the reason includes, like, they have a more customer centric approach. There are various innovative products which are being launched. There has been a lot of technological upscaling by private bank as compared to PSU bank, with the advent of mobile banking, with internet banking and digital wallets and other stuff. Also, the risk management framework in case of private banks is much more efficient than PSU bank. So all these factors have led to a growth in the market share of private banks over the year. Now, uh, if we see the weight of private banks in the total, in the total universe of top 500 companies, so the market capitalization weight of private bank is around 17%, while its contribution to the overall profitability of all those company combined is around 21%. So again, over a longer term, the price growth of any company or index is driven by the earnings growth, is given by the earnings growth of the companies or the index. So now over the past decade, if we see over the past decade, private bank earnings have grown stronger than the broader index. But if we see the current weightage in terms of market capitalization and in term and its weightage in profitability, the weightage in market capitalization is slightly lower. So this indicates that there is a margin of safety in case of private banks, and if and there is a good scope of this market capitalization weight increasing. Uh, there's a good scope to increase. There's a good scope that the market capitalization, the weight in market capitalization can increase, and private bank can outperform over a longer term period. Next, we come to the capital adequacy ratio. So capital adequacy ratio is very important in banking domain as it measures the financial strength of the banks, and it is used to see if the bank has enough capital to absorb any potential losses which might arise. So it is calculated by dividing bank's capital to the risk-weighted asset of the bank. So if we see the graph here, the capital adequacy ratio of private banks in 2015-16 was somewhere around 15%, and which has now grown to around 18.6%. So it means that the private banks are well capitalized as compared to what they were around 8 to 9 years back. And since the banks are well capitalized, there is enough room for banks to support the continued deposit and credit growth. Now let's look at the return ratios, because this is something which is very important from an investor, from a shareholder perspective. The how much returns banks are giving to the shareholders, or how much returns are being given on the assets which are deployed by the bank. So if we see ROE and ROA, so ROE had been falling from 2015, and this was basically the period when the private banks were going through NPA crisis. But in the last 3 years, if we see the ROE numbers, they have improved substantially, and the same goes with the return on asset numbers. The after financial year 2020, the ratio has improved significantly. So and again, the ROA of private banks are at a decadal high right now. So this is again one of the important factor with respect to the return ratios, that it has been improving a lot in the last 3 years. Now let us come to the valuation. How private banks are valued in terms of price to earning ratio and in terms of price to book ratio. Uh, in terms of price to earning ratio, if we see somewhere in March 2021, the Nifty Private Bank Index had reached to an all-time high P ratio, and after that the ratio has been falling, and it has fallen below its historical average of 24 PE. Now the primary reason for a reduction in PE is obviously the stronger earnings growth which was reported by most of the private banks, and that's what has caused the ratio to fall, P ratio to fall below. The same goes with price to book ratio as well, which is again currently uh, trading below its historical average. Thus, for an investor who is looking from a long-term perspective, this valuation ratios can provide a good entry point into this index. Now, again, deposit and credit growth. So, if we see the deposit and credit growth of private banks, they had fallen in 2020 to below 10% levels. But now, if we see post COVID, the recovery is very strong. Again, one of the primary reasons for such high deposit and credit growth is given to the stronger balance sheet of the banks, and the lower NPA ratios which was reported by most of the private banks. Now let's look at the NPA ratio. The term NPA stands for non-performing asset. Now gross NPA, if we see gross NPA basically represent how much percentage of the bank's loans and advances have defaulted. While if we see net NPA, NPA represent how much percentage of the bank's loans and advantage are not being provided for. So whenever any account, let's say, turns NPA, bank needs to make provision against a defaulting account, and that provision is being taken by taking a hit on the profitability of the bank. So a lower gross NPA and a lower net NPA ratio represent that bank is healthy, and banks have already taken a hit on the majority of its defaulting account. So if we see in the during the peak NPA crisis, the private bank gross NPA ratio was some had gone to around 6%, and while net NPA ratio had gone to around 2.5%. But if we see the current if we see the current numbers, gross NPA is at a 8-year low, and the net NPAs had already fallen below its 8-year low price. So this is again one of the this is also one of the a strong point which makes case for private bank investing. Now let's look at some of the performance related numbers. So if we see post financial crisis, private banks have outperformed Nifty 50. And again, as highlighted in the previous slide, the major reason for this is the constant is the consistently increasing market share of private banks, and also increase in the banking coverage. So if we see Nifty Private Bank has grown by around 26x versus 12x by Nifty 50 in the last 18 years. So this again represents a very vast outperformance over a 18-year period. Even on rolling return basis, private bank have outperformed the broader Nifty 50 index. So if you see 1 year period, 3 year, 5 year, and 10 year periods, Nifty Private Bank has outperformed Nifty 50 index. So we have discussed many positive about private banks, but does that mean that PSU banks are not going to perform well, or there is still darkness in PSU banks right now? Again, in the subsequent slide, we will try to see how PSU banks are bouncing back, and why it can be a good tactical bet for an investor who is looking for some short term gains. So now let's directly start with the performance related numbers. So if we see this graph on the left hand side, which is Nifty PSU Bank Index divided by Nifty Private Bank Index, from 2009 this ratio has always been falling. So it means that since this ratio is falling, it means that private bank have consistently outperformed PSU banks from 2010. But there is a change in this ratio from 2021, which wherein the this index have started to grow further. So this is a basically this represent a point wherein PSU banks have now started to outperform private banks. This is now for a last 3 year period, and even if we see on a rolling return basis from 2010 till 2020 to till 2022, tri- private banks have always outperformed PSU banks. But now from 2022 onwards, the dynamics have changed. PSU bank have started to outperform. So again, this is very short period right now, but again the trend have started to reverse. Now again, with respect to PSU bank and with respect to the revival is not limited to only one or two banks. So now if you see this graph here, so this graph provides you the price performance of various PSU banks. And if you see the red line here, the red line provides price performance of the Nifty banking index. So most of the PSU banks in the last 1 year have outperformed Nifty Bank Index. So it means that the revival is not across only one or two banks. It is across most of the PSU banks, and the same is also supported from the ROE numbers. If we see the return on equity of overall PSU bank, which the return on equity was negative 3.5% in March 2022, which has now grown to around 11%. So the return on equity have improved tremendously in the last 3 years. But if we also plot the ROEs of various stocks, so the same trend is visible. So if we see SBI, or if we see Bank of Baroda, if we see Bank of India, there has been growing ROE for almost every PSU bank. So this is again this change is more uh, it is more structural in nature, and it's not been driven by one or two banks. Now let's look at the net interest margin of PSU bank. So net interest margin represent difference between the interest which is received from the loans and advances and investment minus the interest which is paid on the deposit. So it is basically the net interest which is earned by the bank. So higher the net interest, it represents better the profitability of the bank. So if we see from last 3 years, the NIM percentage of the PSU banks have improved very significantly. And this again makes a case for a better profitability of the PSU bank going ahead. Now, very crucial part of why PSU bank can be a good bet. Now, if we see during NPA crisis, PSU Bank were the one which were hit very badly. So, in terms of various default which has happened in 2017 to 2020 period, PSU banks were the ones which had major exposure to them, and that's the reason why if you see during this period, the ROEs of the PSU bank have gone negative. The reason primarily was because they had to take a hit on the defaulting accounts. But now, if we see the gross NPA numbers, so from the peak of 14.6%, it has fallen to around 5% in FY 2023. Similarly, if we see net NPA, from the peak of 8%, it is now at around 1.2%. Now it means that from 8% to 1.2%, it means that the banks have already taken hit of all the defaulting accounts which were there. And uh, and uh, this also represent that worst is already behind us, and maybe going forward PSU banks and going forward maybe PSU banks can have a better profitability since the hit has already been taken. Now, let's look at the representation of public sector banks in the broader index. So, if we see Nifty 500, if we see Nifty 50, if we see Nifty Midcap 150, or in fact, even in the broader Nifty Bank Index, representation of PSU banks is very low. So, it means that if somebody wants to take exposure to PSU banks, they may not get substantial exposure in a diversified index, or even in case of diversified fund. So if someone wants to take a tactical bet on Nifty PSU Bank index, they will have to take it. They will have to take it separately, and for this, a Nifty DSP Nifty PSU Bank ETF can make more sense. Now, when we see PSU banks, there has been lot of mergers which has happened in the past 2 to 3 years, wherein lot of banks got merged with lot of bigger banks, and which has actually helped the PSU banks to have a stronger balance sheet. So if we see the capital adequacy ratio, this has improved significantly. Obviously, there has also been a capital infusion by the government in PSU banks, which has also contributed to this this stronger balance sheet number. But again, since at this moment, if we see the capital adequacy of the ratio is of the PSU banks are very strong, and a stronger balance sheet will help PSU bank to uh, to grow their credit book, and accordingly will eventually will help them to grow their profitability. So now let's look at the valuations of PSU Bank. So if we consider 2009 to 2015 period, so the PSU banks were trading at a price to book value which was more than which were more than 1.2 times. And during this period also, if we see the return on equity was also somewhere around 15%. So accordingly, again, the higher ROEs led to the higher price to book value for PSU Bank. But during NPA crisis, the ROE obviously ROE fell, and even PSU Bank got derated, and accordingly, if we see this NPA crisis period, the PSU banks were trading below, in fact, one time price to book. But now, in the last 3 years, the ROEs have increased substantially, and I mean, so the current ROE is around 11%. Is around 11%. However, the price to book hasn't hasn't catch up much with the growing ROEs. So this again makes a this again makes a case that the run up in PSU Bank may continue further, and this sector may witness further re-rating in case this ROE numbers improves going ahead. So let's go through about the index construct and about the portfolio of both Nifty Private Bank Index and Nifty PSU Bank Index. So if we see the weights, if we see the top weights in Nifty Private Bank. So the top weight is given to HDFC Bank. The next is ICICI, IndusInd, Axis, Kotak, Federal, IDFC, Bandhan, RBL, and City Union. And when we see PSU Bank, State Bank of India has the highest weight, while Punjab and Sindh Bank has the lowest weight. So the weights here are determined by the market cap. So bigger the bank, higher will be the weightage. Higher will be the weightage in this index, and smaller the bank, smaller will be the weightage in this index. If we compare the index features, again, the universe of private bank index are the private sector banks, and universe of PSU banks are public sector banks. The number of stocks for private bank is 10, for PSU bank is 12. No single stock can have more than 33% exposure. So theoretically, SBI in PSU bank, the weightage of SBI can be more than 33% given its market cap. But due to this constraint, the weight of SBI is restricted to below 33%. Again, maximum exposure to top three stocks is around 62% in both private bank index and PSU bank index. Rebalancing is semi-annually. In terms of investment team and process, so DSP Nifty Private Bank Index, DSP Nifty Private Bank ETF and DSP Nifty PSU Bank ETF will be managed by Anil Gelani and Dipesh Shah. So both of them are part of passive team in DSP. So in DSP we have a dedicated passive team which focus solely on passive funds, and they are independent in nature. This is in line with the global practices, and this is one of such cases in the Indian mutual fund industry. Let's look at the risk in both of this index. So the most important risk here is the concentration risk. As you know, this index is solely focused on banking industry. So here an investor will only get exposure to banking industry. Second thing, the number of stock in this index is restricted to only 10 and 12 stocks, with some of the stock having weightages more than 20%. So this again so this both of these index are very concentrated in nature, and due to higher concentration there is a high risk, there is a high volatility, and there will be higher drawdowns in both of this index, as if we compare it to a diversified equity fund. And there will be time when there will be a substantial underperformance with respect to diversified funds and indexes in the short term, and which an investor needs to be aware of. To demonstrate the risk, we have plotted down the calendar year wise return of private bank index, PSU bank index, and Nifty 50 index. So if we see, there are a lot of times when the index has given higher negative return as compared to the broader index, and the same is very high in case of PSU banks, wherein if you can see in the table here, there are a lot of there are a lot of red color shaded returns, meaning that the drawdowns were very higher in this particular year. So that was it about DSP Nifty Private Bank ETF and DSP Nifty PSU Bank ETF. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.